Hey everyone, Richard here from TraderLion.com, and today is the start of our CANSLIM investing series, where we'll be covering the main components of the CANSLIM growth stock trading strategy. And in this video, we're going to be focusing on the first letter, the C in CANSLIM, which stands for current quarterly earnings. And briefly, if you're not familiar with what CANSLIM actually is, it's basically a methodology developed by William O'Neill, the founder of Investors Business Daily, to try to identify high potential stocks that can go on runs of 200 to 10,000% over the course of weeks, months, and years. And in order to form the strategy, he basically went back in time, studied the greatest performing stocks all the way back to the 1800s, and found a whole bunch of common characteristics that they shared before and during these huge, incredible runs. And in this video, as I mentioned previously, we're going to be talking about the current quarterly earnings. And essentially, in order to follow the CANSLIM methodology, we want to see a baseline growth of 25% in terms of quarterly earnings compared to the same quarter 1 year ago. And over the long run within a stock's life cycle, the stock's price trend really follows the trend of the quarterly earnings. As you can see here from Apple, on top we've got the stock price advancing from about 10 all the way back in 2008 to now at 122. And down here we've got the quarterly earnings plotted during the same time frame. You can see that the trend of the stock price really follows the same trend of the quarterly earnings reports. And going back to this slide, we said we wanted at least 25% growth to follow the CANSLIM methodology, but really that's the baseline and bare minimum, because 50% growth, 100% growth, even 200% growth is really going to catch Wall Street off guard and lead a whole bunch of hedge funds, mutual funds, and other institutions to pile into the stock and drive up the price. So moving on, we've got an example here. We've got Apps or Digital Turbine Inc. And you can see that for the past 4 quarters down here, it's reported stellar growth, 67% in earnings, then 180%, then 200%, and now 320% the most recent quarter. And during this time, the stock's price has increased from below 10 to now at one point over 100. So really it's followed this incredible trend due to the earnings growth and really has shown incredible power to keep compounding and produce extraordinary results quarter after quarter. And it's very important to keep in mind that you shouldn't just look at the earnings growth number. You want to get a more holistic picture of the company's performance. And for that, you also want to take into account the sales and after-tax margins. This will show you basically, is the earnings growth organic and will it likely continue? Because if, for instance, you saw that the sales numbers were only growing at like 10, 15%, while the earnings were growing at 100%, or even if the sales growth was negative, you might ask yourself, how are they getting these extraordinary numbers in terms of earnings when their sales aren't growing at all? Are they cutting out kind of R&D and future investments for the benefit of short-term earnings, which will hurt the company in the long run? And similarly, you also want to take a look at the after-tax margins, because this gives you a sense about how is the company performing, how are they operating, are they an efficient, well-oiled machine? So take a look at both the sales and after-tax margins in addition to the earnings growth numbers. And if you see acceleration like this quarter after quarter in all kind of 3 different criteria, this can really lead to a stock price increase like we saw with Apps, where it's an extremely well-run company and it's selling more each and every quarter and earning more as well. And in addition to all this, you also want to be on the lookout for earnings surprises. And what I mean by this is before a company will report, all the analysts that cover that stock and company will basically run their spreadsheets and come up with an estimate of what their earnings will be. And if the company is able to beat the estimates, that can lead to a surprise on Wall Street and dramatically increase the stock's price, as we saw in this most recent quarter. And a company that's able to kind of beat earnings over and over and is accelerating their company and services faster than the analysts can predict is going to dramatically increase their stock's price. As we saw from Apps here, we had its first earnings gap up based on an earnings surprise all the way back here. And we had a whole bunch of other earnings gap ups over the course of this run. So really pay attention to earnings surprises and also beat and raise quarters quarter after quarter. So in summary, we want to see at least 25% growth comparing that quarter to the same quarter 1 year ago. And ideally, we want to see 25% growth or better. 50% growth, 100% growth is preferred. And in addition to the raw earnings growth numbers, we also want to see sales growth numbers improving as well as margins improving, supporting that organic growth. And finally, we also want to see kind of beat and raise quarters as well as earnings surprises, which can catch Wall Street off guard. So that's pretty much it for the video. Thank you guys so much for watching. If you did enjoy, please go ahead and leave a like down below and subscribe if you are new. And I'll see you guys in future videos.